Hi, everyone. My name is Emily Black, and I'm presenting Algorithmic Fairness and Vertical Equity, Income Fairness and Tax Audits, which is joint work with Hadi Elzayn, who is also first author, Alexandra Chouldechova, Jacob Goldin, and Daniel Ho. In this project, through a novel collaboration with the United States Internal Revenue Service, we investigate the impact of using machine learning systems in the IRS audit context as the IRS looks to modernize its audit selection system. We investigate what steps can be taken to prevent inequity from AI systems in the audit context. We focus on investigating the fairness of audit allocations with respect to taxpayer income. To do so, we borrow from the public finance literature to introduce a new fairness framework called vertical equity. Vertical equity has to do with treating different people appropriately differently, as opposed to horizontal equity, which concerns treating similar people similarly, arguably the focus of most common fairness definitions in the literature currently. We find that many off-the-shelf fairness interventions can be ill-suited for the IRS audit context, both due to an imperfect fit of their implementations with a budgeted problem, such as the IRS audit allocation problem, and also due to a mismatch with contextualized fairness desiderata, such as vertical equity. This ill fit of common bias mitigation techniques may be relevant to a wider set of policy contexts, pointing to a need for better tuned fairness metrics and bias mitigation techniques for many policy problems. The focus of our case study is endeavoring to answer the following question. How can we make a machine learning-based audit selection system as fair as possible with respect to an individual's income? We address these questions by exploring real IRS tax data. We use two data sets. First, the NRP data, which consists of line-by-line audits of a stratified random sample of the US population from 2010 to 2014. And secondly, operational audits from 2014, which are risk-selected audits to identify tax evasion. Each observation contains information filed on a tax return, and all dollar amounts are adjusted for inflation to 2014 dollars. We train all of our models on NRP data since it's a stratified random sample, but we start with investigating the status quo of audit behavior on operational data. As a point of departure for this project, we investigate the status quo audit rates. We find that the lower to middle income deciles of the population bear some of the highest audit rates. This graph is of the audit rate, y-axis, as a function of income decile. In other words, groups of 10 percentiles of the US taxpayer population by income, where the x-axis is income in thousands for the lower bound of each 10 percentile bucket. Each point is the audit rate of the decile of the population. We can see that the lower to middle income deciles are audited at the highest rate. However, consider this graph of tax misreporting, in other words, non-compliance by income decile. Again, the x-axis is income in thousands for the lower bound of each decile, and the y-axis is the rate of non-compliance over $200. We can see that non-compliance increases roughly monotonically in income. This leads to a motivating question that will influence our understanding of equity in this context. If misreporting increases roughly monotonically in income, why does audit rate focus so heavily on the lower to middle income classes? In this work, we present the following contributions. We introduce vertical equity to algorithmic fairness. We show that high complexity models can actually exacerbate vertical inequity. We demonstrate that classical fairness promoting interventions are often not well suited for budgeted policy problems. We show that instead, changing a model's prediction target can improve fairness while avoiding a steep performance fairness trade-off. And finally, we demonstrate that agency constraints and policy choices may have a strong influence on audit allocation equity. Thank you so much, and please read our paper for more.